Rule number 1 will completely change how you think about money. Most people think investing is about finding the next explosive trend. They chase hype, pump and dump assets, and overnight millionaire stories. But the world's greatest investor operates on an entirely different wavelength. Warren Buffett famously stated, "Rule number 1 is never lose money." And rule number 2 is, never forget rule number 1. This sounds obvious, but its deeper mathematical meaning is profoundly ignored. If you lose 50% of your capital, you don't just need 50% to get back. You actually need a massive 100% return just to break even. Protecting your baseline principal is far more important than hitting home runs. Today, we are stripping away the Wall Street noise and false promises. We are breaking down the 5 core pillars of the Omaha strategy. These rules have survived hyperinflation, market crashes, and global panic. They work because they are rooted in human psychology and business logic. Let's uncover the true mechanics behind rule number 1, margin of safety. Buffett doesn't buy stocks. He buys underlying businesses at a steep discount. Imagine a bridge built to hold a 10-ton truck safely. You don't build it to handle exactly 10 tons and hope for the best. You engineer it to withstand 30 tons just in case of an error. That extra 20-ton cushion is what value investors call your margin of safety. If a business is intrinsically worth $100 per share, you don't purchase it when the market trades it at 95. You wait patiently until market panic irrationality drives it down to 60. That $40 gap protects you from your own analytical mistakes. If your growth calculations are slightly wrong, you still don't lose capital. This brings us directly to rule number 2. Invest in what you know. Buffett terms this, boundary your strict circle of competence. It doesn't matter how vast or expansive that circle actually is. What matters intensely is knowing exactly where the perimeter ends. If you don't understand a business model inside out, walk away instantly. Rule number 3 requires identifying an unbreakable, long-term competitive moat. In the business ecosystem, every profitable company is under constant siege. Competitors will gladly copy your products, lower prices, and steal market share. A moat is a structural advantage that protects a company's high returns. This can manifest as an incredibly powerful, globally dominant brand name. It could be a massive cost advantage that no startup can replicate. Or it might be high switching costs that lock consumers in permanently. When a company possesses a wide moat, its pricing power becomes bulletproof. They can raise consumer prices during inflation without losing their customer base. Look for monopolies or duopolies that own their respective industries entirely. If the moat is widening every year, the business value grows automatically. This brings us to rule number 4. Assess the management integrity. Buffett looks for 3 distinct qualities in leaders: integrity, intelligence, and energy. But he warns, if they don't have the first, the other 2 will kill you. You want executives who act like true owner-operators of the business capital. Rule number 5 is the hardest to master: lethargy bordering on sloth. Wall Street brokers make money when you constantly buy and sell assets. You make money when you sit quietly on your hands for years. The stock market is a unique game with no called strikes. You can watch hundreds of overpriced pitches pass right by you. You only swing when an absolute fat pitch lands perfectly in your zone. When you find that rare business, buy it and hold it forever. Your compounding engine works best when you leave it entirely alone. Taxes and transaction fees are the silent killers of long-term wealth. By minimizing activity, you maximize the natural law of compound interest. Your portfolio becomes an automated snowball rolling down an endless hill. These 5 rules require no complex algorithmic software or insider connections. They demand emotional discipline, deep patience, and long-term conviction. The system has been proven over 3/4 of a century. Stop speculating like a gambler. Start investing like Warren Buffett. To successfully calculate a margin of safety, you must ignore current market stock prices entirely. Instead, focus your analysis entirely on the company's free cash flow over 10 years. If the cash flows are erratic and unpredictable, the business model fails rule 2. Buffett avoids complex technology sectors precisely because their future cash flows are deeply uncertain. He prefers simple, boring businesses like insurance, brick manufacturing, or classic consumer retail goods. These stable industries don't change overnight, making their long-term value highly calculable. When severe market panic strikes, amateur investors sell their great businesses out of fear. For the disciplined value investor, this emotional market panic is an absolute gift. You are buying real dollar bills from panicked sellers for 60 cents each. This psychological detachment is the true secret behind massive generational wealth generation. You must look at price volatility as your friend rather than your enemy. If you cannot watch your portfolio decline by 50% without panicking, don't invest. The market is there to serve you with prices, not to instruct you. True value remains steady regardless of what the frantic ticker tape displays. Now let's look closer at how to evaluate the structural integrity of a moat. A true economic moat allows a business to maintain high pricing power effortlessly. Test the moat by asking if a competitor could destroy it with $1 billion. If $1 billion cannot steal the customer base, the moat is exceptionally wide. Think about a consumer product that people consume daily without a single second thought. The emotional connection to a brand creates a massive psychological barrier for competitors. Another powerful moat type is low-cost production scale that nobody else can match. When a company operates at the absolute lowest cost, they control the entire industry. They can undercut every competitor while remaining highly profitable and resilient. A dominant green chess piece standing perfectly tall while surrounding white pieces are tilted slightly. But economic moats are not permanent. They require constant corporate vigilance and reinvestment. Great managers spend their days constantly widening the defensive perimeter around the business. They protect the core engine from capital erosion and technological disruption. If the moat shrinks even slightly, your long-term investment thesis is completely broken. Never compromise on moat quality just for a cheaper stock market entry price. An average business at a great price is far inferior to a wonderful business at a fair price. This core realization completely revolutionized Buffett's entire modern capital strategy. Evaluating leadership requires looking directly at how executives allocate their capital. Do they foolishly buy back overvalued shares just to boost short-term metrics? Or do they patiently hoard cash when no intelligent investments are available? Excellent managers are entirely transparent with their shareholders about business mistakes. If an executive report reads like a promotional marketing brochure, walk away immediately. Look closely at the footnotes of the financial statements for hidden corporate debt. High leverage can quickly destroy even the widest economic moat during a crisis. Buffett prefers businesses that generate high returns using zero debt liability. This organic compounding keeps the company completely immune to banking panics. When a crisis occurs, debt-free companies actively buy up their vulnerable competitors. They expand their empire while the rest of the market desperately scrambles to survive. To mirror this success, you must hold significant cash reserves in your personal life. Cash is your fundamental financial oxygen during periods of severe macroeconomic distress. Without liquid cash, you become a victim of market-forcing functions. With cash, you become the absolute master of your own financial destiny. The final secret of the Omaha strategy is the sheer duration of holding. Buffett accumulated over 90% of his massive wealth after his 65th birthday. The media focuses entirely on his brilliance, ignoring the massive timeline element. Compounding interest is a mathematical curve that explodes incredibly late in life. If you interrupt the chain early, you lose the massive exponential payoff completely. Treat every single investment asset like a long-term marriage for life. If you aren't willing to own a stock for 10 years, don't own it for 10 minutes. This structural patience frees your mind from the daily emotional exhaustion of trading. You can completely ignore the screaming talking heads on cable financial networks. Your only job is to let your wonderful businesses work for you automatically. They accumulate profits, expand their moats, and build your long-term empire. This is the realistic, unglamorous, mathematical reality of legendary wealth generation. It requires zero luck, zero speculation, and absolutely zero compromises. Commit completely to the 5 rules, trust the math, and protect your principal baseline. The blueprint has been delivered. Close the laptop, step away, and let it compound. Now that your baseline structure is rock solid, You must monitor structural changes. Checking your stock portfolio every single hour is a toxic psychological trap. It induces unnecessary anxiety and forces you to make emotional, short-term trades. Instead, schedule a formal portfolio review just once every 6 months. Review the underlying business fundamentals, not the temporary stock market price. Has the company's competitive moat widened, or has it started to erode? Are the net profit margins remaining entirely stable against rising global inflation? If the business fundamentals remain intact, your correct action is absolute silence. Only reallocate capital if a business fundamentally loses its core competitive edge, or if the market overvalues the stock to an absurd, dangerous bubble degree. Selling an outstanding company simply because its price went up is foolish. You are cutting your beautiful flowers to water your fast-growing weeds. Let your massive winners run continuously for decades without any artificial limits. This hands-off approach minimizes capital gains taxes, saving you millions over time. Let's pivot to the deep internal philosophy of true, generational wealth building. True wealth is entirely quiet, invisible, and deeply rooted in personal restraint. Most people confuse rich lifestyles with long-term financial independence and security. Being rich is about current income display. Being wealthy is about unspent assets. Warren Buffett has lived in the exact same modest home since 1958. He drives an unpretentious car and avoids the empty trap of luxury consumerism. He treats capital as a magnificent tool for freedom, not for social status. When you break free from the need to impress others, your savings skyrocket. You keep your overhead minimal while your compounding asset engine accelerates rapidly. This structural surplus allows you to strike aggressively when great opportunities appear. You operate from a position of absolute, unshakable long-term financial strength. You never have to accept a bad business deal out of desperate necessity. You possess the ultimate luxury in modern society, total control over your time. That is the magnificent destination these 5 investing rules ultimately lead toward. It is a quiet, deliberate empire built entirely on logic and patience. Now let's look at how this system behaves during historic economic crises. Economic recessions and sudden market crashes are an absolute mathematical certainty. They occur roughly once every single decade due to human emotional cycles. Amateur investors spend their lives trying desperately to time these cycles perfectly. They think they can sell at the absolute top and buy back at the bottom. Buffett completely avoids this guessing game, calling market forecasting total nonsense. Instead, he builds his portfolio to be completely unshakable regardless of conditions. When a severe crash occurs, his cash reserves act as a massive weapon. While other funds face liquidations, he goes on an historic shopping spree. He acquires dominant monopolies for absolute fractions of their true intrinsic value. This opportunistic behavior during panics turns market downturns into wealth accelerators. To execute this, you must train your mind to love market declines. When your favorite grocery store cuts prices by 40%, you celebrate. You should view the premium stock market with the exact same consumer logic. Panic is your ultimate wealth generator. Stability is simply your maintenance phase. Let's assemble the final execution blueprint so you can begin immediately. Your lifetime roadmap to Omaha-style wealth generation breaks down into 3 habits. First, ruthlessly define your specific personal circle of competence starting tonight. List the exact industries and business types you genuinely understand inside out. Second, start building a structural cash reserve that you never touch for lifestyle. This liquidity protects your peace of mind and acts as your deployment fund. Third, wait patiently for market inefficiency to hand you a deep discount. When the right deal enters your zone, execute with absolute size and conviction. Do not diversify into 50 different mediocre companies you barely know anything about. Concentrate your capital into a few wonderful businesses with wide, structural moats. Then, let the magnificent law of compounding interest do the rest automatically. This strategy isn't about complex financial formulas or fast-paced trading algorithms. It is a game of emotional temperament, unshakable discipline, and massive structural patience. The financial system rewards those who can think in terms of decades instead of days. Stop hunting for shortcuts, embrace the realistic math, and protect your baseline capital. The rules are set. The math works. Turn off your screen and let's build.